I'm Joe Janzen from the University of Illinois, and this is a 5-minute Farmdoc. Today I'll talk about an important trend in U.S. agriculture. Our grain storage capacity has stopped growing. Storage infrastructure, think of the bins, elevators, and sheds used to keep grain in good marketable condition, is an important part of the U.S. grain supply chain. It helps facilitate efficient, low-cost movement of commodities from producer to end user, helping to ensure that farmers receive the best price for their crops. In a recent article for Farmdoc Daily, I examined trends in grain storage capacity, production, and stocks using data from the National Agricultural Statistics Service. I find the history of our storage infrastructure has 3 sub-periods. First, storage infrastructure consolidated in the 80s and 90s, following the end of government policies that encouraged large grain stockpiles. After the year 2000, we saw 2 decades of steady storage capacity growth that matched production increases nearly bushel for bushel. Storage capacity grew by about 350 million bushels per year, and production of all crops, while fluctuating from year to year with changes in weather and crop yields, grew by an average of 340 bushels per year. The industry was building storage to match production growth. But something changed around the year 2020. Production continues its upward trend, but capacity growth has slowed considerably. In the 6 years since 2020, we've added only 337 million bushels of storage capacity, less than what we typically added in a single year during the prior period. Storage capacity has remained essentially flat while production continues to grow. The dashed line shows where production and capacity would be if the 2000 to 2019 trend had continued. Based on that prior trend, we would have had 27.5 billion bushels of capacity today. Instead, we're at about 25.5 billion. In December 2025, the most recent data point we have, production came within 5% of total capacity. That's the tightest margin seen in the data. You might wonder whether this capacity growth halt is happening in specific regions or across the country. You might ask if it's farmers or grain merchants, the 2 big operators of grain storage, who stopped investing in capacity growth. The data on this point are clear. Storage capacity growth has flatlined everywhere. I look at off-farm storage, that's commercial elevators and terminals, and on-farm storage, the bins on farmers' properties, in 4 regions where most of the grain production and storage capacity exists: the Eastern Corn Belt, Western Corn Belt, Northern Great Plains, and Southern Plains. There's a few observations. Some of the regions have more storage than others, and the mix of on-farm and off-farm storage varies. There's more storage capacity in the Corn Belt, where big corn yields generate a greater volume of grain. More than 13.5 billion bushels of capacity lie in the states between Ohio and Nebraska. The Western Corn Belt and Northern Great Plains, regions generally farther from ports and end users, have proportionally more storage on farm. Farmers in those areas typically need to store grain for longer. Most relevant to our discussion is that after 2020, capacity growth has slowed across all regions and all facility types. This is a nationwide pattern affecting both farmers and commercial grain handlers. So, what happens when capacity growth slows while production continues to increase? Farmers and others use existing storage capacity more intensively. I calculate a measure of capacity utilization, the proportion of storage capacity being used to hold grain inventories, on the 4 quarterly dates assessed by USDA: December 1st, March 1st, June 1st, and September 1st. Storage use follows the marketing year for corn and soybeans, the biggest crops in the US. December is right after harvest, so storage utilization is highest then. By the following September, just before the next corn and soybean harvest, utilization has declined as grain moves to end users. While storage use varies from year to year with changes in crop size, the longer run trend is towards greater capacity utilization. Comparing December storage capacity use across 4 subperiods, I find for the 1988 to 2005 period, average post-harvest utilization was about 60%. Since 2014, it's been closer to 70%. In the past 5 years, U.S. farmers have been using their space more intensively, filling their bins more and drawing them down to lower levels. December capacity utilization was roughly 70% on-farm compared to just over 60% off-farm. The most recent data suggests this trend has continued. As of December 1st, 2025, farmers held large inventories relative to storage capacity, with a capacity utilization rate of 80% on-farm compared to 65% off-farm. Why does this matter? Storage capacity is infrastructure that facilitates grain movement through the supply chain. When utilization rates increase, there's less flexibility in the system. We've seen in other contexts, like the Mississippi River transportation constraints of a few years ago, how infrastructure limitations can affect local prices and farmer marketing options. At current utilization levels, it's worth asking whether we're approaching a point where the capacity constraints could affect market function. particularly in specific locations with higher storage utilization rates. This analysis raises several questions worth considering. First, at what level of utilization might capacity constraints begin to affect supply chain efficiency and price relationships? And second, what factors are driving farmers and grain handlers' recent decisions about investment in grain storage? Understanding why capacity growth has slowed could help us anticipate future trends. In the article, I offer some hypotheses, but the answer is not clear, and so these are questions that farmers and others in the grain industry must continue to examine. Thanks for watching. And if you want to read the full analysis, check out the link in the description below. With a 5-minute farm doc, I'm University of Illinois agricultural economist Joe Janzen.